$100. That's the minimum payment on a $5,000 credit card balance. Sounds manageable, right? Here's what they don't tell you. $92 of that payment goes straight to interest. $8 goes to your actual debt. $8. That's it. The rest is profit for the bank. At that rate, it takes 9 years and 7 months to pay off, and you'll pay $11,520 total for a $5,000 balance. How does a $100 monthly payment turn $5,000 into $11,000? And how did a couple in Texas making $161,000 a year end up with $90,000 in credit card debt, paying nothing but minimums? This is that story, and the system behind it. Alyssa is 40, registered nurse in Houston, Texas, pulls in $111,000 a year. Good money. Connor is 32, works construction, about $50,000 a year. Combined, they bring home $161,000. Top 20% of American households. They've got a house, 2 cars. One of them is a Tesla with a $53,000 loan. Monthly payment over $1,000. From the outside, they look like they're winning. According to TransUnion, the average American with a credit card balance owes $7,886. Alyssa and Connor owe more than 10 times that. It started the way it always does. Small charges, groceries, gas. A dinner here, a new jacket there. Then came the bigger ones. In 2022, they took a vacation to California. Flights, hotels, restaurants, experiences. $20,000 on credit cards. Connor said they deserved it. They both work hard. They earn good money. And here's the thing, they weren't being reckless. Not in the way you'd think. It was lifestyle creep, the kind that happens so slowly you don't notice. A nicer dinner becomes the normal dinner. A weekend trip becomes the expected weekend trip. Spending rises to meet income and then it passes it. Alyssa later admitted that stress played a role too. Long shifts at the hospital, the pressure of bills, shopping became a release valve. Buy something, feel better for an hour. The credit card made it frictionless, no cash leaving your hand, no pain signal, just a tap. Here's a question. If you make $161,000 a year and you can't pay off your credit cards, is the problem your income? Or is it that spending became normalized at a level your income can't actually support? Here's what most people miss. You can't out-earn bad credit card habits. A higher salary just means higher limits. Higher limits mean bigger balances. Bigger balances mean more interest. The math doesn't care how much you make. By the time they sat down on Caleb Hammer's financial audit, their credit card debt had crossed $90,000. $90,000, spread across multiple cards. And they were paying only the minimums. Caleb ran the numbers on one of Alyssa's cards. At her current minimum payment, it would take 25 years to pay it off. Another card, 17 years. He looked at them and said, "You guys are going to be approaching 60 by the time this is paid off." 25 years of minimum payments. On a single card. According to the CFPB's 2025 report, the average credit card interest rate in America is now 25.2%, the highest in at least a decade. So why do banks set the minimum payment so low? Because they want you to pay it, not your full balance, just the minimum. Credit card companies typically set minimums at 1 to 3% of your balance, or a flat $25 to $35, whichever is more. The most common formula is interest charges plus 1% of principal. That means on a $5,000 balance at 22% APR, your $100 minimum sends $92 to interest and $8 to principal. $8 a month toward what you actually owe. Here's what you should know. That minimum payment is presented as relief, a small, manageable number. But in practice, it keeps borrowers in debt far longer than they expect. The bank earns interest every month you carry a balance. A lower minimum means you carry it longer. That's not a flaw in the system. That is the system. And there's science behind it. In 2009, researcher Neil Stewart published a study in the journal Psychological Science. He found that displaying a minimum payment acts as a psychological anchor. When people see a low minimum number on their statement, they pay less than they would have otherwise. It's not a coincidence. It's behavioral economics. The number anchors your brain to a lower amount. A study by Wharton and the National Bureau of Economic Research found that at least 22% of people who pay near the minimum are directly anchoring on that displayed number. Here's a simple rule. Never look at the minimum. Look at the balance. Pay as much as you can above the minimum. Even $50 extra a month cuts years off your payoff timeline. Let's run the real numbers. $5,000 balance, 22% APR, 2% minimum payment. Month 1. You pay $100. $92 goes to interest. $8 goes to debt. You still owe $4,992. Month 2. You pay $99.84. $91.53 goes to interest. Balance barely moves. After 1 full year of payments, you've paid about $1,100. Your balance dropped to roughly $4,600. You paid $1,100. Your balance dropped by $400. Keep going, year after year. 9 years and 7 months later, you've paid $11,520 for a $5,000 balance. You paid the bank more in interest than the original debt. Now let's make it worse. A $2,500 vacation on a credit card, standard APR, 2% minimums, 30 years to pay off. Total cost, $8,397. That beach trip, it cost you 3.4 times the sticker price. Here's what you can do instead. If you're carrying a balance, try making a payment before your statement closing date, not just the due date. Depending on how your issuer calculates interest, paying earlier can reduce your average daily balance and lower future interest charges. It can also improve your credit utilization ratio. Most people don't know this. Alyssa and Connor aren't alone. According to the New York Federal Reserve, total U.S. credit card debt hit $1.277 trillion in the fourth quarter of 2025, the highest ever recorded, $1.277 trillion. And Americans paid $160 billion in credit card interest and fees in 2024 alone. That's up more than 50% from 2022. Let me put that in perspective. $368 million in interest accrues every single day across American credit cards. Every single day. At this point, ask yourself, how much of your monthly payment is actually going to your balance? 27 million Americans can only afford to pay the minimum, not because they're careless, because the math traps them. Once you're deep enough in, the minimums eat your paycheck and the balance barely moves. According to Bankrate's 2026 report, 61% of Americans carrying credit card debt have been in debt for at least 1 year, up from 53% in 2024. The problem is getting worse. There's a man named Dave who called into the Ramsey Show. Single father, 5-year-old daughter, lives in Los Angeles, $140,000 in credit card debt. Not a mortgage, not student loans. Credit cards. Individual cards ranging from $22,000 to $32,000 each. Interest rates between 25 and 32%. His monthly income, $8,400. His housing costs alone, $4,200. Half his income, gone before he buys groceries. The co-host looked at him and said, "Your house is not a blessing, brother. It's killing you." Dave accumulated the debt during a family crisis 3 years ago. Emergency expenses, medical bills, living costs when income dropped. The cards were supposed to be a bridge. They became a cage. Here's the hard truth. If you're in this situation, the first step isn't a magic app or a balance transfer. It's knowing your real numbers. Pull every statement. Add up every balance, every APR, every minimum. You can't fight what you can't see. Then call your card company. Ask for a lower rate. According to a LendingTree study, 80% of people who asked got a reduction. Most people never ask. The credit card industry isn't broken. It's working exactly as designed. Top credit card companies are now more profitable than before the pandemic. The CFPB's own report says this signals a lack of competition. The average APR margin is 15.4 percentage points above the prime rate. That's not a small markup. That's the price of convenience turned into a profit machine. Capital One leads in consumer complaints filed with the CFPB. The agency filed a federal lawsuit against them in January 2025. Bank of America was ordered to pay $30 million for withholding promised credit card rewards and opening unauthorized accounts. Dave Ramsey calls credit cards financial cigarettes. Addictive by design, profitable for the company, destructive for the user. Here's what this story teaches us. 1. The minimum payment is not your friend. It's an anchor designed to keep you in debt longer. Pay as much above it as you can. Every extra dollar goes to principal. 2. Know your numbers before anything else. Pull every statement. Write down every balance and APR. You can't make a plan if you don't know the battlefield. 3. Call your credit card company and negotiate. Ask for a lower APR. Ask to remove a late fee. Ask to change your due date. 80% of people who ask get a rate reduction. The phone call takes 10 minutes. 4. If you're carrying a balance, consider paying before the statement closing date, not just the due date. It can reduce your average daily balance and lower future interest costs. 5. If you're drowning, look at the debt avalanche method. Pay minimums on everything except the card with the highest APR. Throw every extra dollar at that one. When it's gone, move to the next. 6. Since 2010, Americans have paid $2.1 trillion in credit card interest, more than all outstanding student loans and auto loans combined. This isn't a personal problem. It's an industry. Drop a comment and tell me, what's the highest interest rate you've ever paid on a credit card? I read every single one. If this video made you think of someone, a friend, a sibling, someone who's only paying minimums, send this to them right now. It might be the wake-up call they need. Subscribe and hit that bell. We do this every week. Take care of your money. I'll see you in the next one.